Hey, everybody. Welcome to Market Mavericks. We're back here on another Thursday at 3 p.m. Eastern time. Again, joined by Mike McGlone and Scott Melker. How you guys doing today?
Hello.
Great.
Good. All right. So let's get into this market. All right. So, Mike, I'll kick it off with you. We got CPI yesterday and PPI. Can you give people a rundown of what the data meant?
A little bit higher than expected across the board. That was not expected. Even our economist Anna Wong thought they'd be a little bit weaker. And so that's taken the Fed hike probability next week down to virtually guaranteed we're going to go 25. It's very likely we're going to go 50. So I think I'm going to start it out the way Greenspan did his 1994 hikes, just 25, 25, 25. Made a lot of money during that period. I can explain to you later how we did that. But so looks like that's what we're going to be 25 cut next week. Inflation's still sticky. And the way I look at it is, they always come up with little reasons like owner's equivalent rent and all these little things. But I look at it in the macro is when you have the stock market at 2 times GDP, it's the most in a century. I don't really think you can get inflation to go down until stock market goes down. So I think we're beginning that cat and mouse game where the most widely anticipated easing cycle in the history of mankind. Of course, I'm trying to be like Trump on that one, exaggerating a little bit. And Scott and I, we've been bantering about this one forever. It's going to start next week. And we sure have had a lot of buy the rumor. And you just look at all risk assets are quite expensive. And now we're all, yeah, great, they're going to start cutting rates. But it's not because things are looking rosier from an economic standpoint. Obviously, we know the shift now is towards increasing unemployment.
Do you guys think that there's a chance? So we have a decision next Wednesday, September 18th, and then there's not another Fed meeting for, I think it's about 6 weeks, right? Which is a little longer than the monthly. Yeah. Do you think that the market is going to fret between that 25 basis point cut and the next one because they start to think the markets are behind, or the Fed is behind the curve?
I think it's all the above, but say the next one's going to be November 7th. That's 2 days after the election. To me, it's the uncertainty around the election. Now, we do have a former president who's still not admitting that he lost the last election. So there's a risk of a not affluent transfer of power, which used to be, what made this country great. So we can go there if we want, but it's kind of entertaining. So there's risks around the election. I've heard people like Jim Bianco say they think the Fed's being very political. I completely pull back on that because if the Fed was being political, they would have already cut 50 and they might cut 50 next week. They haven't even cut yet, and they're cutting 25. And they're walking us through this all the time. So I think we're seeing the content of character, the profiles and courage in Mr. Powell. I mean, he pushed back on Trump initially, and they're just waiting and doing exactly what they think. They've gotten inflation back to near their targets, unemployment's increased, and they should start cutting rates. The thing is, with inflation running, PPI is 2%, CPI is around 3%, Fed funds are still very restrictive. And that's where, from my standpoint, in terms of commodities, we're seeing significant deflationary forces. And I'll end with one statistic. It came out this weekend from my colleague, Joe Levington. Auto loan delinquencies have increased for 34 straight months now. Wow. That's the most since 2009. That's just a fact.
It's amazing, right? So we have a situation where we'll get 25, but then the markets may worry for the next 6 weeks that they're behind the curve. And then they're likely, do you guys agree that they'll go 50 then in November and 50 in December? I mean, I think that's what's priced in, or Scott, you're shaking your head.
If it's priced in, I assume it's going to be wrong because that's been the case for 2 years. So predictive markets have been the easiest counter trade in the history of mankind. If you've been looking, we were supposed to, as we've talked about in this show many times, by the end of 2023, we were supposed to have 5 cuts if you were looking at the predictive markets 19 months ago. So no, I don't think that's necessarily the case. I want to point to something, though. I had an interesting conversation yesterday. It's going to come out on Sunday with Campbell Harvey, who's the economist that actually did the original paper on the yield curve inversion predicting recessions. He did it in 1986. Everybody points to that paper and says it was the 10-year 2-year, but he points out that it's the 10-year 3-month. But the 10-year 2-year has actually now normalized for the first time since, I've got the chart here, since June 22, right? This has been effectively the longest period of yield curve inversion in history. And as we've also talked about here, you tend to get the yield curve inversion, then a Fed pivot, then the stock correction that we've been talking about here quite a bit. And his point was that we're still inverted on the 10 and 3. So that actually does show that recession, whether soft or hard landing, coming a bit later than the 10-2 is showing us. But he still believed, and he's 8 for 8 since 1986 with the yield curve inverting before a recession. He believed that the Fed is already behind and should be cutting 75 points to 100 now for a lot of the reasons that Mike laid out. And he even went deeply into the fact that CPI is basically improperly calculated with lagging data, which is something that we've talked about here many times. Owner equivalent rent, as Mike said, that was over 5%. If you look at data from Zillow or apartments, any of the people who are doing it on a day-to-day basis, those numbers are sometimes negative. So I think he was agreeing, without me saying it, with Mike saying that the deflationary effects are already here and that the Fed is way behind and they need to get ahead of this. And they're always behind in every direction, which we know. So I would say that there are still a lot of indicators. I mean, there's an article right now here on Bloomberg, housing's worst crisis in decades reverberates through 2024 race. Right? We know that the housing is the most expensive that it's ever been right now. There are a lot of signals that things could get worse. I don't think it means depression. He wasn't saying that. He actually thought a soft landing was somewhat likely, but his point was that soft landing will be the fault of the Fed. Any recession will be the fault of the Fed because they should have been cutting already.
So I got to follow up on that a little bit. Owner's equivalent rent, I remember analyzing that in the trading pits 3 decades ago. I still think it's kind of silly that if you're rich and you own a big house and it doubles in value from $1 million to $2 million, that shows up in inflation. But you're sure loving that extra money that you can actually borrow from with whatever kind of home equity loan or anything. But that in the past, actually during the 70s, mortgage interest rates were considered part of CPI. They pulled it out. It was wrong. And then they restated some of the CPI, some of modern equivalent. So, this is humans about making error corrections and figuring out, as Jeff Booth says. But I want to point out the one thing on my chart that I just want to show, I guess I got to share it, is that I like to measure. I think that you went to the way to measuring the curve. Instead of 2 10s is like the standard. I like to go with the whole curve, and that is 3 T-bills to 30 years. And this is where we are now. I used to be in that 30-year trading pit in the futures in Chicago Board Trade. That's where I started. And still 100 basis points inversion. That's the most since crude oil futures started trading. That's what I show you in orange. This is just gold divided by crude oil. It's going up. Why? Because we've never had a situation the curve has been inverted for this long, and it's just going to revert. It's just a question. So I think that just means gold versus crude oil is going to reach a new high. It's not a big profound thing, but it's how we stand on this and how I like to say sometimes you have to throw out the models and look at the history books. This is just getting started. But for the Fed to go to more than 25 basis points is going to take one key factor. And I think that is obviously unemployment going up, and that is stock market going down. Because right now, they are dealing with, it's just very rare for the Fed to be aggressively cutting rates with the stock market in such a tear. Now, I remember 2007 when they started cutting. There was a good reason. I mean, spreads were blowing out, and we had some major issues with mortgage debt back then. Remember, we had BNP and these ETFs, or these hedge funds going under. But right now it's not there yet. But that's my point, is if gradually then suddenly the risk is if they start going 50, it's going to be because the stock market's told them to. And that to me is a risk I think we're facing. At some point we're going to get there.
Yes. One thing I wanted to bring up here is that Jamie Dimon just two days ago brought up, his quote was, I wouldn't say the worst outcome is stagflation, or I would say the worst outcome is stagflation, recession, higher inflation. Dimon said at fall conference from Council of Institutional Investors in Brooklyn. And by the way, I wouldn't take it off the table. I mean, I know, Mike, you've been in the camp of deflation. Do you think there's no chance that if they start cutting aggressively and the U.S. debt keeps spiking, that there's no chance of stagflation?
Oh, there's always a chance. Yes, there is. But I think let's start with what's happening in China. Clear deflationary trajectory. That Chinese CGB 10-year note at 2.10%. It's the lowest ever. It's 150 basis points below the Fed fund before U.S. 10-year note, and it typically trades at a premium to Fed funds. So we are seeing severe deflationary forces in China. We're seeing pretty significant recessionary trajectories in Europe on why they cut rates today. And the U.S. is the shining star. And the U.S. stock market is the lifting everything. That's why I look at the boats are all being lifted by the stock market, yet they're still sinking. And that's why I think the deflation starting in China, it's trickling down, and you're clearly seeing in the commodities. So I published today, you look at crude oil, natural gas, the grains, iron ore, or as of yesterday, they're all down about 25% on a one-year basis. That is virtually never happens without yields declining and the stock market plunging. Now, it is in China. Or both are happening. Stock market's down, what, 25% on a year-over-year basis, depending on which one you look. It's how long the U.S. can remain isolated from that. And I look at it, this is part of that great reset that unfortunately I started writing about 2 years ago, that's trickling down and just happening. And that's why I tilt over the Bitcoin. That's why I think Bitcoin, part of the reason I think Bitcoin's going to continue to underperform is because it should be leading this. And so far it has. It's just now every day that, you see gold make a record high today, S&P 500 bouncing, Bitcoin's just meh. That's not a good sign.
Yeah.
It's not a good sign that gold's outperforming the stock market.
Yeah. I just brought up the Bitcoin chart. I wanted to ask Scott about this. I mean, to me, it seems like it's just kind of a dead market right now. There's not a whole lot going on. But I mean, are there any undercurrents of positivity? Like if you were trying to say to someone, what's the reason to invest now? Do you have a thesis for that?
Absolutely. And that thesis hasn't changed. And if you've been listening to those who've been here since March, they would have told you it's going to be really miserable by September. Mm-hmm. Right. And I find it absolutely hilarious that if you looked at like the crypto fear index in February on the way up at 58,000, you would have seen extreme greed. And you look at it at 58, 7 or 8 months later, and you've got fear or extreme fear because people just can't stand waiting. Right. Even and those, I had David Young. We may have talked about this, but from Coinbase on my show recently. And he said, listen, in May, I came on your show. I put out a paper. This is the head of institutional research for Coinbase. He said, we'll have a really rough Q3 and a very constructive Q4. And he said, I'm going to say I have a lot less conviction in that now. And I said, we've just had a terrible Q3. How can you have low conviction now in Q4? Nothing's changed. He said, I don't know. Now that we're here, it's different. And I think it was he basically admitted that that's the phenomenon of being a human being in the markets, is that even if it's going the right way, you still need to see it go up, or you're going to doubt that it ever is going to do that again. I mean, for me right now, we have a potential higher low for the first time in this entire market structure. It's not confirmed to me. You see all these blue, like lower low, lower high, lower low, lower high. Well, if we put in the low at 49 and we confirm this low at 52, which would require, by the way, getting up above about 65, that could be finally this market structure changing and moving into something, as he would have said, more constructive, sort of into the election or after it. I think a lot of people are waiting for the election here, but nothing has changed for Bitcoin. It's become more institutionalized. There's a lot more interest. There's a lot more eyeballs on it. And price is still wonderful. It's $58,000. If you went back a year right now and asked me what the price would be of Bitcoin and you said it's going to be 58, I would have been ecstatic.
So I got to piggyback on that. It's there's one thing that I learned having lost my hair in this business is when you listen to the World Gold Council, do you ever expect them to be bearish gold? When you listen to anybody from Coinbase, they are physically paid to be bullish cryptos. I've been there. I was on that side of the business. You got to be very careful. So that's one thing I'd love being neutral on this and just point. I got to throw some my chart decks because I'm going to be probably reiterating this tomorrow and just look at the pure facts. Bitcoin has been is at 23. Ounces of gold to Bitcoin. It looks like it's going back to 15. That's not profound to say that. There's a good reason for that to happen. Look at the S&P 500 versus its 100-week moving average. There's only one time since 1999 it's got expensive as 2021. It's just going to head back to par, just a matter of time. Let's look at Bitcoin versus beta. Why shouldn't it go back to 7? Right now, it's Bitcoin's 10 times the stock market. There's no reason it shouldn't go back to 7. There's a good reason for it to do it. If you just look at S&P 500, the amount of ounces of gold per S&P 500 could easily go back to 2. That's been support. Historically, it used to be 1. So I need to point out also another thing. We'll just take Bitcoin versus its 100-week moving average. It's clearly a maturing asset, risk asset. And bottoms in Bitcoin have a history, and we know how this one was. This was for a while, of getting about 50% below its 100-week moving average before making a decent bottom. We haven't had the 50% correction. And I just overlay this with the same chart of the Hang Seng Index. So I look at this as from an unbiased view. You have to be very careful from people on the sell side of the business who are paid to have a view. And that's why you have to respect our listeners and our bias. So if you're bullish and long, be careful of personal biases and look at the facts. I'm just pointing out the facts is underperformance. Right now, on almost 4 years now, Bitcoin's been underperforming the NASDAQ. And at a certain point, we're seeing outflows from that massive pump we saw in those ETF inflows, because people are starting to realize, okay, this asset hasn't been performing, and what's going to make it start performing? I think that's part of the risk I see, is that we just see the one thing I keep showing all the time is this one. And just see a little bit of reversion upward in volatility. That's what this is. This is just the VIX Volatility Index, 52-week moving average. Some of us made a lot of money on this 16 years ago. We had to eat the pain for a year, minus a T-bill rate. It's just starting to turn up. Now, I overlay this with gold divided by crude oil, because from my standpoint, I'm obviously biased. As a commodity guy, there's only one commodity that's really going up, and that's gold.
So Scott, just turning back to Bitcoin, and I just wanted to bring up my chart here just to quickly show. So we can see that, here you had the low on the S&P, higher low, and same thing on Bitcoin. So it appears to be following the stock market, which means risk asset. But like, are we still seeing the same sort of things that we see in general consolidation phases, like more addresses? I remember, over the last few years, there were like certain things that were like, okay, well, at least that's good that we're seeing more interest. Is that still happening?
Yeah, I think I'm looking it up, but I think Bitcoin hash rate, the network itself, just made yet another all-time high. Yeah, it did. You can bring it up right here. Dave Weisberger loves to point this out to Mike McGlone when we're on together on Mondays, right, Mike?
Oh, yeah.
And so, yes, all of the actual data for usage and those things continues to go up. But there's long been a debate as to what that actually means with regard to price, because I think it's loose. Some say that this leads price. Others say that price leads this. And I think you can't draw any conclusions. But yes, there's no question that there's been more adoption of the network with time. People like Raoul Paul and others love to point at the adoption curve of the internet and the adoption curve of Bitcoin. And Bitcoin's has been steeper and faster even than the internet. There's a lot of reasons to love Bitcoin. I even think, Mike, I don't want to put words in your mouth, but if you weren't looking at it from macro, which nothing exists in a vacuum, but we have talked about Bitcoin for years, and in a vacuum, when you looked at it that way, you viewed it as the fastest horse in the race and saw the reasons with the adoption and Metcalfe's law that it would perform well. I think you just believe that it's at the pressure of everything else, right? Is that a somewhat accurate assessment?
That's part of it. I think there's significant reason to say the next big trade, which was Bitcoin, is no longer the next big trade. I'm looking over at,
I think that's fair.
TLT is above par. It should easily get to 130.
100.
I mean,
There's
it's
TLT.
at par. I mean, I just see it going to 130 for a simple reason. And you can show that in the chart, and I can show you my other one reason. Just China tells me it's going there. And that's what I show you here. This is one thing. If your TLT is like 30-year or 20-year, but if you take the U.S. Treasury minus the 10-year note Treasury in China, this discount here is the same as it was right before the great financial crisis. And then I overlay that with the S&P 500 versus its 100-week moving average. It's much more expensive than it was in 2007. And we've already seen the deflationary forces out of Bitcoin. This is versus 100-week moving average. Now this is BCOM. It's already showing severe deflationary forces from the Bloomberg commodity indexes. It's all going that way. And I think Bitcoin's just leading the way. So here's the thing we have to worry about, I think, from a human nature standpoint, that sometimes markets do make peaks. I think Bitcoin did. I think it's going to see some pain. And the thing is, right now, we need to see beta to keep going up. And typically that meant Bitcoin would outperform. That's not been happening now for what, 6 months or 5 months? At some point you have to say, okay, maybe that peak we put in, which was the most hype peak I've ever seen, will be an enduring. And it's just going to continue doing this. Now, I'd love to see that divergent strength, but I'm pointing out the facts of performance and then a good reason for that high. So, yeah, I love the things like hash rate and stuff. I focused on that when I was really bullish Bitcoin, when the masses hated it and people like Mr. Trump thought it was silly internet money. But now that they've all tilted that way, I mean, it's the best of Bitcoin's over. Either way, see, it's in the mainstream. And those ETF inflows, which was 17 billion now, starting to turn towards outflow because of poor performance. What's going to change that? And that's what I look at as the next big trade is just starting to happen. Bond yields going down, catching up to China, deflation. And it starts with one key test. We just need to see that little 10% correction in the stock market. We haven't had one of those since that bottom in Q4 last year. Doesn't mean it's a bear market, but let's get through that test first. The fact that we're not having it and we're getting towards some periods of the year where you should be very careful when everybody's bullish, that's when I think rational investors get out, and that's part of the reason I see. Again, here's another day. Gold's making new high. S&P 500 is very well below it, and Bitcoin's just, it's not doing it.
Mike, where do you think gold goes? Like, let's say we're talking 2025. I mean, obviously I'm bullish on gold, you're bullish on gold. Do you think it goes to 3,000? I mean, do you think there's even more upside than that?
Who knows how long, but one bridge at a time. That's why I'm looking one bridge at a time for the stock market. Just give me that first 10% correction and then see how everything adjusts and see how TLT and Bitcoin funds performs. So right now, gold, I think the next key step is about 3,000. Just a question how far. I love to overlay it with crude oil because it's been going up versus crude oil, certainly since that bottom right before the financial crisis, around 7. Right now, it takes about 37 barrels of WTI per 1 ounce of gold. I think it goes to 60 because if crude oil goes to 50, which is normal, and gold goes to 3,000, that's a 60 ratio. Now we've been there already. We've been at high as a ratio of almost 90. Right now it's only 37. So here's a key reason why. Again, I show you that inverted curve. There's so much room for inversion. Most traders have never seen that. Anybody who's been trading crude oil since 1983 and futures have never seen this. You have to go back before crude oil futures started in 1983. So that's why things are different. You have to focus on the value here. So I think the thing I'll point out about gold is it's way overdue for that bull's way overdue for some bucking. And it hasn't really had much bucking. It went up to 2,400, hung out. Now it's at 2,500, it's hanging out. It typically has some bucking and some volatility. And here's one reason why. Managed money net futures positions, net longs, are about 46% of total COMEX open interest. The highest they ever been, and I think we have 20 years of data, is 49%. And that was near the peak in 2011. I was trading it then and just didn't sell as soon as I should have. But so it's overdue. But the key thing is we had outflows in ETFs for 4 years. They're turning back upward. So gold to me is the major go-to here, particularly if what you see, and there was not one mention of the deficit in that debate on Tuesday. I don't think so. Everybody looks like, okay, well, this is a problem. So maybe we'll get a split Congress and executive branch. We'll see if that fits. That would be helpful. But gold is a pretty decent bull market. You have to be careful overweighting long here, but futures are overweight long here. And the key thing, I'll end with this. The key thing that I'm worried about is we've seen a breakdown in crude oil. We're seeing a breakdown in most commodities. The one key one that's the outlier is copper. Copper, I think, is ready to follow bond yields lower. It'll probably be a trigger, might be the U.S. stock market. And managed money spec positions are still very long copper, which means there's a potential catalyst. They're waiting to hit those stops.
Do you guys, just turning quickly to silver? I mean, are you guys as big a fan? Do you think silver? I mean, there's so many smaller traders that just love silver. I think part of it is the price of silver. But is that going to have a run to 50? I mean, 50 is where it was. I think in the 70s it hit 50, and then again in 2011.
Yeah.
I mean, is that headed there at least?
I love that gold to copper ratio. Gold to silver ratio. It's about 86 or so. Sir Isaac Newton was ahead of the English mint. I think it was 15, 16. Dave Weisberger loves it. He knows that history so well. And it's probably going to 100. It's just the thing about silver is it's not, as Dave says, gold's been demonetizing it for centuries, and it's continuing to demonetize it. Central banks are not buying silver. It's much more like copper. Copper's industrial metal. Silver's industrial metal. If China is in decline, silver should continue to lag in this rally, even though typically silver's been considered leveraged gold, but it's not anymore. The world's changed. The questions are the same, the answers have changed. So on a 1 year basis, they're both up about 30%. Silver should be up closer to 45% if it traded with this typical volatility versus gold. So right now it's lagging. $30, maybe it gets to 32. Maybe if gold makes another new high, maybe silver gets to 35. But it's just lagging beta in that space, which is gold. And I'm still think that gold to silver ratio will continue to widen.
Chart looks great though.
Scott, oh sorry, buddy.
No, I'm just saying the chart looks great for silver. I mean, it's a pretty unbelievable chart.
Well, okay, well this chart is very similar. That's why I've overlaid. This is actually gold versus crude oil, but it's the same type of chart. Just overlaid, take silver instead of crude oil. It's the same thing. They've all been doing that same. But the bottom line, I think, is I need to emphasize this fact. It's the thing I can't emphasize enough. When you, like me, when you know there's going to be a lot of pain in the market, just a matter of time. I remember seeing in 2006-07, you need to warn people. It's just the nature. And this to me is where that pain begins, when volatility just reverts. And that's not, it's volatility always mean reverts. It's just very low. It's just, that's where we're so complacent now. We got a lot of reasons. First of all, I think the macro is so significant. We have had this period of détente for 3 decades. That's over. We have a Cold War 2.0 kicking on. And of course, then we have this contentious election. So that's the next few months. Maybe we can hover like this for a while, but the next little let's just put it this way: when volatility is this low, it's basically it's a tinderbox waiting for a spark from our mean reversion.
So just turning back to the crypto sector, Scott, one of the things that it's been frustrating, I think, for a lot of people is the altcoin market. I mean, like if you look at this Ethereum chart, even compared to how Bitcoin's been performing, it just sucks, frankly. And then you look at some of these other altcoins and they just keep drifting lower. I mean, is there hope? I mean, would you even invest in these names anymore?
Yeah, I think now's the time because we're having this conversation. They tell you to sell in May and go away, but they don't tell you have to remember to buy in September. There's got to be a time that you're going to buy back, right? And so if you've gotten I take you look, this is ETH versus Bitcoin. To your point, I mean, yeah, it was at 0.057 in May when you could have gone away, already way down, by the way. Now you're down to 0.04 versus Bitcoin, right? I'm sorry, these don't go down forever. And there's going to be a time for these things to move. Ethereum has an ETF. It's completely dead as far as inflows, of course. But I see nothing different right now from previous cycles, except that we got the Bitcoin spot ETF and Bitcoin jumped way ahead, way out over its skis ahead of the rest of the market, but none of that trickled down. We all know that in previous markets, Bitcoin moves, then people get bored and it trickles down to the other things. Well, when you have a Bitcoin BlackRock ETF sitting in your IRA, you can't really sell that to buy a Solana meme coin, right? And so it hasn't trickled down yet, but it's just going to take a little retail kick in the pants. There's no guarantee we get that. I do believe we do again, though. Why not? Crypto is still hyped. It's becoming more of the mainstream asset. And then I think these things will start to jump. But for right now, it's still a Bitcoin dominated time. Bitcoin dominance continues to generally rise. I think you'd rather be in Bitcoin, but if you're a long-term, like you buy things when everybody's telling you about how they're dead and asking you if there's ever going to be a time they're going to go up again, right? And that's the conversation I'm consistently having that we're having right here. So plus I think Solana might be a stronger bet because it's performed exceptionally well, but I do think that these are going to do quite well. I'm starting to see that fear and greed, right? It's the crypto fear and greed, not just the Bitcoin fear and greed. And if you're wondering why there's extreme fear right now, it's a little, I did say earlier, it's funny you looking at the Bitcoin price, but when you count the whole market in there, this is the reason that it's so bad, is because anyone holding anything that's not Bitcoin generally has gotten absolutely destroyed.
Sorry, you go.
I got to add something to that. I have to add, if you're, we saw what happened with ETFs. They basically failed in Ethereum ETFs, partly because you don't really get the yield, right? But the Bitcoin, Ethereum to NASDAQ index is the same as it was 4 years ago. Okay, at some point you have to say, why should I buy Ethereum when I can buy Qs? And to me, that's what's happening right now. And it's also below the peak from 2017. Yeah, people say I'm picking a point in time, but this is, to me, what's happening is this space that a lot of us have made a good living on is done. It's not the next big trade anymore. I think, and my thing is telling me it's due for what the NASDAQ did from 2000 to 2002, and the U.S. stock market did from 1929 to 1933. And it's overdue for more lower, because remember what we're talking about: highly speculative digital assets, completely dependent on the whole tide going higher, and that seems to be waning.
So we just have 2 minutes left, right? So one thing I was going to bring up is in terms of unexpected events or economic data. So right now, the Fed's still leading us to believe there's a soft landing. I'm getting the sense that neither of you really believe that, just because the Fed's never been able to engineer that before, and the data is not supporting that based on inversion, uninversion, all that kind of stuff. But if you guys had to say, so answer that question, and then what would be the one thing that you think will surprise investors here into year end?
I think soft landing is possible, by the way.
Okay.
I just think, but it depends on how you define it and how they're going to redefine it, and whether it's based on NEBR or whatever, NBR, or whether it's based on quarters. We redefine recession every single time, so they're going to tell you it's not bad, even if it's terrible on the streets. But I do think that a shallow recession is a possibility. I think you have to put that out there, that they might engineer that. But I would love to hear Mike's take.
Well, the surprise is normal mean reversion. I have to show you one chart going back 60 years. And the surprise a year ago was crude oil was going to 40. McGlone was the idiot. And 2 years ago, McGlone's the idiot. I'm less the idiot now. And I just shown you a chart of crude oil going back 60 years, and going back to 40 is a meh, nothing. It's what it always does, but there's a good reason for it. And again, I show you this is unemployment rate. You have to go back to 68 for last time unemployment bottom from civil level. So crude oil going to 40 always happens, at least since the Iran-Iraq war. Some of us remember that well. And unemployment going to 60 always happens, going since 1947. That's normal. That's starting to happen. That's going to happen in my view, but it'll be taken as a shock by the market, I think, when it does happen. And oftentimes it's gradually then suddenly, and I think we're in that place right now where we're starting to maybe trickle towards suddenly, where, okay, we completely priced out that recession. We'll just go back to what you mentioned, Scott, when you spoke to the economists earlier, is that, yeah, it's coming. And so far, US, it's happening in the rest of the world, most notably China.
Wow. All right. Well, that's it, folks. Thank you, gentlemen, for joining us. Socials at the bottom. Make sure you follow each and every one of us guys on social media. We do appreciate it. And we will be back maybe next Thursday. I think, Scott, you might be away, so we'll see. But either way, guys,
it'll be 3 a.m. for me, but maybe.
Yeah. We won't push it on that one. But anyways, folks, have a wonderful rest of your week, and we'll talk to you guys soon. Take care.